If you track extreme moves in the market, you probably saw this one. The headline at the end of December was just a shock. VivaCore Inc., that's ticker VIVK, saw its stock price just crater. It dropped nearly 65% in one session, pushing the share price down to, barely more than a single cent. It was hovering right around $0.012. I mean, that's the kind of drop that screams bankruptcy or, catastrophic earnings, maybe a massive fraud investigation. But according to the analysis report we're looking at, the cause was none of those things. It was purely regulatory. So our mission in this deep dive is to figure out if this crash is, the final death spiral for this company, or if the specific way it happened has created a really counterintuitive buying opportunity. We have to break down the bare reality first before we can even get to the potential bull case.
What's fascinating here is that we can pin that 65% loss to a very specific non-business trigger. This wasn't a sudden failure in their oil field business. It wasn't a disastrous quarterly report. It was, I guess you could call it an artificial event, driven purely by compliance.
Okay, so let's get the timeline straight. What was the exact moment, the exact trigger for this collapse?
The trigger was the delisting. So on December 26th, VIVK was officially removed from the NASDAQ. It was then moved to the lower tier over-the-counter markets, the pink sheets.
Right, and a move to the OTC is never good news.
Never. But the immediate 65% drop wasn't just a reaction to the move itself. It was about the legal mandates that, kick in right after.
And that's the part we need to unpack for you, the listener. Because why would a change of trading venue cause such a violent, immediate crash? You'd think big institutional funds would be slower to react.
That's the crucial context. The second VIVK was off a major exchange like NASDAQ. It triggered something called forced liquidation. Think about the big players, ETFs, certain mutual funds, pension funds. They all operate under these really strict rules in their charters.
Rules that say what they can and can't own.
Exactly. And many of those charters explicitly prohibit them from holding stocks that trade on the OTC markets.
So they're not sitting around debating the company's Q4 earnings forecast.
Not at all. They're simply checking a compliance box.
Your hands are tied.
Completely.
Yeah.
Their internal mandates say they must sell these shares right now. And it doesn't matter what the price is. There's no discretion. It's just a regulatory necessity.
So it's not selling based on a bad outlook.
No, it's selling based on a rule book.
And the analysis calls this artificial selling. That phrase seems really important because it suggests the selling pressure isn't. It isn't organic. It's just a huge wave of mandated supply hitting the market all at once.
That's a perfect way to put it, a tidal wave.
What's the timeline on that? Are they selling over hours, days, weeks?
In a case like this, it tends to be incredibly violent in the first 48 to 72 hours, right after the announcement. These big funds, they have to report that they're back in compliance, and fast. They're not trying to get the best price for their shares.
They're just trying to get out.
You're trying to exit the position, period. And the sheer volume of that selling just completely overwhelmed any existing buyers, which is what drove the price down to that 1 cent level.
Okay, but let me challenge that for a second. The analysis says it was only compliance, but couldn't the delisting itself be a signal of deeper problems? Maybe the institutions were already nervous and this was just the final nail in the coffin.
It's a fair point, and it's a necessary one. The analysis does acknowledge that, VIVK probably failed a minimum bid price rule to get delisted in the first place. But the bull case really hinges on separating that initial compliance failure from the crash that resulted from it. That 65% drop on December 26th was driven by the volume of those compliance exits. It wasn't a reaction to some new catastrophic piece of business news.
Which is where it gets really, really interesting. Because if that selling pressure was purely artificial, then the price, that 1 cent price tag, it might not reflect the true value of the business at all. The price reflects a liquidity crisis, not a solvency crisis. So the analysis frames this as this massive valuation gap. The whole idea is that once that wave of forced selling finally dries up, and it has to eventually, right? There's nothing left to push the price down. And the actual business fundamentals, which everyone ignored during the panic, should start to matter again.
And this is where the raw numbers in the analysis just become kind of astonishing. This valuation gap is what makes this whole thing a real deep dive case study. Let's just look at the math.
Okay.
At a share price of $0.012, VivaCore's entire market cap. So what it would cost to buy the whole company is about $2.3 million.
$2.3 million. For an operating company in the oil services sector, that sounds tiny.
It's minuscule, especially when you put that market cap next to their sales figures. According to the report, they're trailing 12 months revenue. Their TTM is sitting at around $125 million.
Wait. Let me process that. $2.3 million market cap versus $125 million in annual sales.
Yes.
How is that? I mean, how is that even mathematically possible for a company that isn't actively liquidating its assets.
It is the definition of a stark discrepancy. When you run the ratio, the company's trading at roughly 0.02 times its annual revenue.
0.02.
Yeah. And the analysis report really stressed this point, calling the ratio absurdly low. It notes that valuations this low are usually only for companies that are deep in, like Chapter 7 or 11 bankruptcy.
Or they're selling off equipment for pennies on the dollar.
Precisely. So the market is pricing a $125 million a year business as if it's already dead and buried.
That's the true scale of the inefficiency that this regulatory action created.
It is. This isn't just about buying a small discount. This is about potentially buying a high-revenue, functioning company priced at 2% of its annual sales. So if the company can just survive this regulatory transition, that valuation gap is massive. It's screaming for a correction.
It's the ultimate test of separating market panic from business reality. But that brings us to the next big question. Was the underlying business actually healthy? Or was it just limping towards delisting anyway? While the stock was collapsing, what was the actual business doing?
The analysis points to several really significant moves that were just completely overshadowed by the NASDAQ drama. First, let's talk debt. Throughout 2025, VIVK successfully cut its total debt load by a substantial $65 million.
$65 million in debt reduction. For a company this size, that's huge. That should immediately lower financial stress, improve the balance sheet.
It should. It shows management is actively tackling the financial risks. And they weren't just fixing the books. They were also focused on growth. Just days before the delisting, this was on December 22nd, VIVK announced they signed a letter of intent, an LOI, to acquire a company called Coyote Oilfield Services.
And Coyote isn't just a random purchase, right? This move specifically expands their pipeline and terminal capabilities. Those are crucial infrastructure assets that feed right into their highest margin business.
Yes, it's very strategic, and it connects directly to the bigger picture of their recent performance. If we just look at the third quarter of 2025, things were already trending up before the crash. Q3 revenue hit $17 million, up 7% year over year. But here's the kicker. Their gross profit didn't just inch up, it skyrocketed 173%.
A near tripling of gross profit while the stock is being punted to the pink sheets. The contrast there is just it's incredible. It really reinforces that idea of the selling being artificial.
It does. It suggests an underlying business health that is completely at odds with the price action we saw.
Okay, so we've got the artificial cause of the crash, we've got this staggering valuation gap, and we have positive business fundamentals underneath it all. Now we have to get practical. Let's talk about the setup. The analysis report is very, very clear that this is a high-risk, speculative, contrarian play.
Absolutely. It needs surgical entry and very strict risk management. Because the opportunity is based on the speed of a potential rebound, you have to look at both short-term and long-term targets.
So let's outline that potential reward from the analysis. The entry zone is identified as the current panic lows, so between, say, half a cent and the current price of about 1.2 cents. If a contrarian buyer gets in there, what's the immediate potential gain?
The immediate potential is what the analysis calls target 1. This would be a recovery move driven purely by the forced selling just stopping. This would mean a return to the levels right before the delisting, which would be in the range of 3 to 5 cents per share.
From the current price, that's a 200 to 400% gain.
A 200 to 400% gain, yes. Just based on the liquidity normalizing. It would be a very violent snapback rally.
And that's just on recovery from the regulatory panic. What about target 2, the true reversal based on those fundamentals we talked about?
Target 2 is a longer-term idea. If that Coyote acquisition actually closes, if management stays disciplined on debt, and if those improved earnings continue for a few quarters, then the analysis suggests a move back towards 10 cents or even higher is possible. That would still be a very low valuation, but it represents a recovery to where the stock was maybe a year ago. However, this raises the most important question. What are the serious risks here? Because the rewards sound high, but the potential for a total loss has to be just as high.
Let's start with the risks that are just baked into the company's financial structure.
The first, and maybe the most critical one, is the dilution danger. VIVK has a documented history of raising cash by selling cheap shares. They use these registered direct offerings. Now, this keeps the lights on and it funds growth, but it directly dilutes the value for existing shareholders. It just increases the total number of shares out there.
So if they need cash for the Coyote deal, they could just flood the market with cheap stock and kill any rally before it starts.
That's the constant tension here, exactly. The company survives by undercutting the value of its own stock.
What's the second major risk?
That comes directly from its new home, OTC volatility. Trading on the pink sheets means way less liquidity than on NASDAQ. The bid-ask spread, that gap between what a buyer will pay and what a seller will accept, can be extremely wide.
Which means if you decide you want to sell, you might not find a buyer anywhere near the last price you saw.
You might not. It can be very hard to get out when you want to. And beyond liquidity, there's the transparency issue.
Right. NASDAQ has really strict reporting rules. What happens on the pink sheets?
Those reporting requirements drop off a cliff. For the average person trying to do their homework on a company, it gets much harder. Audited financial info might be slow to come out or less detailed. That lack of transparency just compounds the risk. You're taking a much larger leap of faith.
So the ultimate warning from the analysis is essential here. This is strictly for capital you can afford to lose, 100%.
It's a bet on the business fundamentals overpowering all these regulatory and liquidity challenges of the OTC market.
The core takeaway from this whole deep dive is it's powerful. VIVK is a falling knife, no doubt about it, but one that, according to this analysis, is landing on a pile of $125 million in revenue and new acquisitions. The market hates this stock right now purely because of the delisting, and that has created this massive and maybe temporary inefficiency.
That inefficiency, that 0.02 times revenue multiple, that is the gap you're looking at. It's a test of whether you believe institutional rules can overpower actual growing business fundamentals.
Even if that business is now in the wild west of the pink sheets.
Right. And the analysis report suggests watching that 1 cent level very closely. Think of it as the floor of the institutional panic. If that price holds firm over the next few days, it's a strong signal that most of the forced selling is over. And if that happens, the bounce could be violent and swift because the force holding it down is just gone.
So what does this all mean for you, the learner? This case study is a really profound illustration. It's about the difference between a stock price moved by external compliance, that artificial selling, and a price moved by what the company is actually doing and earning. To even consider a situation like this, you have to be able to separate that loud, temporary market noise from the quiet, underlying business reality. That's what gives you the confidence to think about a contrarian position when everyone else is running for the exit.